In today's video I am going to share with you how to trade smarter by using candlestick pattern, so without further ado let's get started. The candlestick is composed of three parts, the upper shadow, lower shadow and body. The body is colored green or red. Each candlestick represents a segmented period of time. The candlestick data summarizes the executed trades during that specific period of time. For example, a 5-minute candle represents 5 minutes of trades data. There are 4 data points in every candlestick: the open, high, low and close. The open is the very first trade for the specific period and the close is the very last trade for the period. The open and close is considered the body of the candle. The high is the highest price trade and low candlestick tells a story of the showdown between the bulls and the bears, buyers and sellers, supply and demand, fear and greed. It is important to keep in mind that most candle patterns need a confirmation based on the context of the preceding candles and preceding candle. Many newbies make the common mistake of spotting a single candle formation without taking the context into consideration. For example, a hammer candle represents a near-term capitulation bottom if it forms after 3 preceding bearish candles, whereas hammer candle that forms on flat sideways candles is basically useless. Therefore it pays to understand the story that each candle represents in order to attain a firm grasp on the mechanics of candlestick chart patterns. These patterns tend to repeat themselves constantly, but the market will just as often try to fake out traders in the same vein when the context is overlooked. Candlestick charts tend to represent more emotion due to the coloring of the bodies. It's prudent to make sure they are incorporated with other indicators to achieve best results. The following are some of common candlestick reversal patterns. There are 4 types of pattern commonly used by traders: bullish reversal, bearish reversal, trend continuation, and indecision. Candlestick. The hammer is a bullish reversal candlestick. It is one of the most, if not the most widely followed candlestick pattern. It is used to determine capitulation bottoms, followed by a price bounce that traders use to enter long positions. Hammer candlestick forms at the end of a downtrend and indicates a near-term price bottom. The hammer candle has a lower shadow that makes a new low in the downtrend sequence and then closes back up near or above the open. The lower shadow, also called a tail, must be at least 2 or more times the size of the body. This represents the longs that finally threw in the towel and stopped out as shorts start covering their positions. Is a bearish reversal candlestick indicating a peak or top. It is the exact inverse version of a hammer candle. The star should form after at least 3 or more subsequent green candles, indicating a rising price and demand. Eventually, the buyers lose patience and chase the price to new highs of the sequence before realizing they overpaid. The image below represents the design of a typical candlestick. There are 3 specific points: open, close, wicks, used in the creation of a price candle. The first points to consider are the candle's open and close prices. These points identify where the price of an asset begins and concludes for a selected period and will construct the body of a candle. Each candle depicts the price movement for a certain period that you choose when you look at the chart. If you are looking at a daily chart, each individual candle will display the open, close, upper and lower wick of that day. In the image below, you can see an example of bullish reversal candlestick pattern, which is commonly used by traders, that includes hammer pattern candlestick as shown in the picture below, and bullish engulfing pattern as follow. The inverted hammer and shooting star also look identical. The only difference between them is whether you're in a downtrend or uptrend. An inverted hammer is a bullish reversal, a shooting star is a bearish reversal. Both candlesticks have petite little bodies, filled or hollow, long upper shadows, and smaller absent lower shadows. The doji tells traders that buyers and sellers were balanced at the end of the day, but this may have big implications. If sellers have been dominating and pushing the price down, a doji suggests that the buyers held their ground. Doji may indicate bullish and bearish reversals in an asset's price. The underlying idea behind the continuation pattern is that the likelihood of the trend continuing in the same direction is higher than the chance of a reversal taking place. For instance, the buyers are in control of the price action as long as the uptrend is taking place. There is a series of the higher highs and higher lows. Hence, the side that has been in control so far has a higher chance of winning the upcoming matches than the side that has been on the losing side. After a strong move to one of the two sides, the price action starts to move sideways on a temporary pause. This period is ended once there is a confirmed breakout in the direction of a previous trend. To recap, what we explained in this video was we learned that every candlestick pattern has 4 data points. One is bullish reversal candlestick pattern and the second was bearish reversal candlestick pattern and the other one was indecision candlestick pattern and finally trend continuation candlestick pattern. If you enjoyed this video, please subscribe to this channel. Thank you again for sticking around to the end and I hope to see you in the next videos.